With Red September here and crypto markets looking shaky, are you panicking? Don't. I'm sharing my top 5 strategies to not just survive, but protect and even grow your portfolio this month. For years, September has carried a reputation as one of Bitcoin's weakest months. Analysts note that multiple Septembers have delivered negative returns, and that volatility often rises during this period. This video will arm you with actionable strategies to navigate the historical headwinds and turn potential fear into a strategic advantage. You'll learn how to safeguard your assets, identify opportunities, and emerge stronger from Red September's storm. Understand the Red September landscape before diving into tactics. It's important to understand why September is often volatile. Historical seasonality. Statistical data shows that September tends to be a weaker month for Bitcoin. Seasonal bias doesn't guarantee a drop, but it increases the probability of corrections compared with other months. Recent volatility. In late August, Bitcoin slid below 111,000, triggering roughly $70 million in liquidations on Binance. Analysts focused on 20-week exponential moving average around $108,000 as a key support level and warned that seasonal headwinds could persist. Macro uncertainty. U.S. core inflation rose to 3.1% in July 2025, the highest in 5 months. Investors are debating whether the Federal Reserve will cut interest rates at its September meeting, which could inject even more volatility into crypto markets. Understanding these dynamics helps frame the strategies that follow. Strategy 1. Dollar cost averaging into quality assets. DCA involves investing a fixed amount at regular intervals regarding of price. It's a stress-free approach during high volatility months because it reduces emotional trading by sticking to a schedule. You avoid panic selling or FOMO buying. Focus on core assets. Bitcoin and Ethereum remain the bedrock of most portfolios. Bitcoin's scarcity, institutional adoption, and network security make it a macro hedge, while Ethereum's dominance in DeFi and staking rewards provide long-term value. Both assets have historically recovered strongly after downturns. Historical opportunity. Weak months often create the best buying windows. Consider allocating more of your scheduled DCA contributions when prices dip. Historical weakness doesn't guarantee future performance, but it does suggest that disciplined accumulation can pay off over time. Key watch points. Track Bitcoin and Ethereum's short-term support levels, currently around 20-week EMA for Bitcoin, and be ready to deploy funds if those levels hold. Strategy 2. The Barbell portfolio approach. Instead of concentrating your entire portfolio into one type of asset, balance it like a barbell. Core weight in Bitcoin as the most established crypto asset. Bitcoin tends to be less volatile than smaller altcoins and can hedge against broader market declines. Selective altcoin exposure. Allocate a smaller portion to promising altcoins with strong fundamentals and institutional backing. Examples include Ethereum, DeFi leader with ongoing institutional inflows via ETH, ETFs, and consistent network upgrades. Solana, high throughput layer 1 with growing developer adoption and potential ETF approval on the horizon. Cardano, known for conservative development and strong community. Large holders continue to accumulate amid ongoing updates. This barbell approach provides upside exposure while maintaining a solid foundation in Bitcoin. Adjust the weight based on your risk tolerance. For example, 70 to 80% for Bitcoin, 20 to 30% across select altcoins. Strategy 3. Risk management and maintaining cash reserves. In a volatile month, capital preservation is just as important as chasing returns. Here's how to manage risk effectively. Use stop-loss orders. Setting stop losses below critical support levels can limit downside if market breaks lower. Revisit these orders frequently as price action evolves. Control position sizes and avoid excess leverage. BitGet analysts stress using proper position sizing and reducing leverage to avoid liquidation cascades. Keep a strategic cash position. Holding cash allows you to buy dips and act quickly when opportunities arise. It also helps you avoid being forced to sell at a loss to cover margin calls. Strong risk management ensures that you survive any unexpected downturns and have dry powder when the market stabilizes. Strategy 4. Monitor macro and on-chain signals. While price charts tell part of the story, macroeconomics and blockchain analytics offer deeper insights. Federal Reserve and inflation. Core inflation running at 3.5% may influence the Fed's September 18 policy decision. A rate cut could act as a bullish catalyst, while continued tightening could extend the slump. Geopolitical events. Keep an eye on election cycles, trade tensions, and regulatory announcements, all of which can introduce unexpected volatility. On-chain metrics. Metrics like short-term holder realized price and MV/RV ratios for Ethereum can indicate whether an asset is undervalued or overheated. Look for divergence between price and network activity. For example, rising active addresses despite falling prices to spot accumulation zones. Staying informed helps you differentiate between meaningful signals and noise. Strategy 5. Don't succumb to FUD fear. Uncertainty and doubt can be just as destructive as market downturns. Recognize bias. September's negative reputation may become a self-fulfilling prophecy as traders preemptively sell. Challenge herd mentality by focusing on fundamentals. Avoid emotional trading. Social media often amplifies panic. Stick to your plan, verify information, and tune out sensationalism. Stay long-term. Remember why you invested in crypto: technological innovation, long-term adoption, and financial sovereignty. Resist the urge to make drastic portfolio changes based on daily price moves. Cultivating emotional discipline is critical to surviving volatile periods. Surviving Red September isn't about luck, it's about strategy. By understanding historical patterns, using DCA, balancing your portfolio with a barbell approach, practicing risk management, monitoring macro and on-chain signals, and avoiding FUD, you can not only protect your portfolio but position it for future growth. If you found these tips helpful, smash that like button and subscribe for more expert insights. Which strategy resonates most with you? Let me know in the comments. And remember, patience and preparation are rewarded in crypto. Use this September to refine your approach and build a more resilient portfolio.